The next aspect that we look at after budgets is we look at variance analysis. Some people call it standard costing. Yes, we look at variances from the budget. That's all. So we look at another part of budget, and that is what we call it as a flexible budget. Now, why do you need flexible budget? Because I've got a set of slides. I'll quickly run through the slides also, and please note these slides are from the textbook. And the prescribed textbook for the course I have already indicated in the outline, which is already uploaded, because there are 3 textbooks which I use for this entire course. One is on the accounting part of it, financial accounting, and some bit of cost accounting part of it, and any entries. Then there's another textbook which I use for management accounting part of it, and there's another textbook which I'm going to use for the finance part of it, that is Stephen Ross. Now, these textbooks are the prescribed textbooks for this course out there. I am picking up excerpts from these 3 textbooks out there and utilizing the material from these 3 textbooks only, and these are the prescribed textbooks for this course. Now, we are looking at variance analysis. We are looking at, there is a budget, there is a variation in your cost figures. Now, I want to know, why is it that there is a variation? What is the root cause of this variation? As you can see on the screen out there, as of now, what we are looking at out here, the root cause for this variation. Once you identify the root cause of the variation, then you can take action. Variances we always classify into favorable and unfavorable variance. Now, always is favorable variance good? Not really. For example, I have a budget, as you can see in the example which I am going to take now, again from the textbook. I have a budget expenditure for about making 500 units of a particular product. And I have all the cost figures for making 500 units of a particular product. But bottom line, I end up making only 400 units of a particular product, not 500. So what happens? All my cost figures are less than the budget. So if you look at the cost figures, everything will have a favorable variance, because the amount of money that you actually spent is less than the budgeted amount. So is it good? Well, no. Because what happened? Your output itself has reduced. So now what happens? I have to prepare. That is where we flexible budget, we flexi. So now I will say, using these cost figures which I have for 500 units, I am going to prepare another budget for 400 units and then use that for comparison. This budget for 500 units what I made, it is not going to be ideal for me to compare my actual output with this, because I have to prepare another budget, flexi, keep it flexible out there. Why? Only then I will know what is the variance, where am I spending more, where am I not spending more, and so on and so forth. We can see this. I'm just looking at a couple of aspects out there. Budgets, all of us know, planned activity, etc. Now, we are looking at performance evaluation of this. What are the specific characteristics of this? We prepare budgets for the relevant level of activity. We prepare budgets for the actual level of activity out there. There is a standardized budget ready. Now, I flex that budget for the actual activity that basically actual output or actual activity performed out there. Now, I flex the budget. That is where I have taken an example. Lawnmower service out there. Again from the textbook. What is the need? Of course, it helps performance evaluation, helps control, and so on and so forth out there. Let's take this. Let's walk through this example. I've got 2 more numerics to work on this. Let's work on the numerics also. Larry's Lawnmower Services provide lawn care in a planned community where all lawns are approximately the same size. At the end of May, Larry prepared his June budget based on mowing 500 lawns. He has prepared a budget based on mowing 500 lawns. Since all of the lawns are of similar size, Larry felt the number of lawns mowed in a month would be the best way to measure overall activity of the business, which is perfect. Now he says, this is what he has got. In this phase, what you see in this slide, Q is nothing but the quantity. Quantity is 500 lawns out there, as you can see in the bracket. I say I move 500 lawns, my revenue is going to be 75 into 500. My wages and salaries will have both fixed and variable component. That is what you see here. The fixed component is 5,000. The variable component is $30 per lawn. So 30 into Q. My gasoline and supplies is only variable 9Q. Equipment maintenance is 3Q, whereas my shops and utilities is fixed $1,000. Office rent is 2,000. Depreciation, insurance, and so on and so forth. And he says, I expect a net profit of $5,000 out there. Please note this again from the textbook. So what happens? But when he actually finishes the actual results, he has not moved 500 lawns, he has moved 550 lawns, and this is his revenue and expenditure statement out. Now let us do a comparison in the next slide. Base level of comparison, what you will see, oh, my revenue is favorable, 5,500, fantastic. My wages and salaries is unfavorable, my gasoline supplies is unfavorable because it's all variable. Please note, he has moved more number of lawns, 550, he has not moved only 500, he has moved 550 lawns out there. So all this, and I will say my net operating profit was expected only 5,000, I have expected 6,450 I have got. So it is favorable, it's fantastic, I close the chapter. No. Please note, this planned budget cannot be used for comparison. The planned budget, based on the planned budgets of whatever you see on the, based on the planned budget of, sorry, of whatever you see here, where my pointer is, the revenue and cost formulae, I will have to prepare a budget for, flexible budget for these 550 lawns out there, and then compare and then look at the favorables and unfavorables out there. So what do? I am just going to next one. This is basically what I have explained. Favorable occurs when actual is greater than budgeted revenue. Unfavorable occurs when actual cost is more than the budget, and what do you call it, and so on and so forth. In this case. Now, this basically is a deficiency in static planning. Static planning will not help you, because static planning, what happens, will basically give you a wrong estimation out there. That is what is static. Now what are we going to do? Let us look at flexible. We will change it out there. Now I will say, I will prepare a budget for 550 lawns. $75 is the revenue I expect. If 550 lawns is what I amount, 75 into 550, 41,250 I have just given you out there. Same way, all the other expenditures. And I will say, if I amount 550 lawns, I should have a net operating income of 6,650. Now I will take it for comparison in the next look at. That is where I look at activity variances. You can see activity variances. My budget, flexible budget is what you call it as 550 and so on and so forth. Now let us look at the activity itself is varied. That is what you see. The activity variance itself is favorable from the planned and flexible budget. I am comparing only the planned and flexible budget out there. Planned and flexible budget out there. I am not comparing anything else. Now let us compare with the actual results in the next stage out there. The actual results out there in the next stage out here. That I will compare with the actual results. So what happens? My actual results, I got 43,000. I should have got only 41,250. I have got 17,750 favorable revenue variance. Favorable variance. Whereas I am looking at the cost. Ideal flexible budget cost is 5,000 plus 30 into 550, that is 21,500 what you see, whereas my cost is 23,500, 2,000 unfavorable variance. Now let me go back and check on this. Why? What for? Is the cost really gone up? Have I splurged it somewhere? What is the reason? I can now look at exploring out there. I look at gasoline. I say 9Q, 9 into 550 should be 4950, whereas I spent 5,100 unfavorable. My equipment, I spent only 1,300, whereas I could have spent about 1,650 favorable. My office utilities, I spent 950, favorable, the rest of it out, and insurance is unfavorable, and then my profit, I should have got 6,650, but I've got only 6,450, so unfavorable. These are all what we call it as spending variances. The earlier one, what you call is revenue variance, and these are all spending variances out there. Let us try and see if we can work on some numbers out there, some numericals out here from this part. Let's take examples of two examples out here. Let's take two examples out. Vulcan Flyovers offers scenic overflights on Mount St. Helens, the volcano in Washington state that explosively erupted in 1982. Data concerning the company's operations for the month of July appear as below. They have also given you the best part is flexible budget in this case. Now just prepare a flexible budget performance report for July that includes revenue and spending variances and activity variances. That's all what they've got. Of course, which variance should be of concern to the management explain, let's worry about it as we go along. Let us try and see if we can work on these. Let's try and see if we can work on this. I'm going to look at this particular aspect out there. Question number 5. Out here, we are going to solve it. Let us look at as we go along out here. Let us look at in this case. Actual, flexible and planned out here. All the three figures again out here. Let's look at out here in this case. The actual results, then what do you call it as revenue and spending variances. Revenue and spending variances. Next, I have my flexible budget. Next, I have my activity variance. Next, I have my planning budget. Planned budget or planning budget or whatever you might call it, want to call it. Okay. First, let's start with flights. I'll give it as Q as the alphabet out there. Actual results 48. Let us not look at the variance. Flexible budget 48. My planned budget was 50 out there. Please note, I am looking at two variances, revenue and spending variance. I am looking at the activity variance itself. Now let us look at revenue at 320 per Q out there. What is my actual result? My actual result is 13,650. What is my flexible budget? What should have been there? It should have been 48 into 320. It should have been my flexible budget out there. I should have got about 15,360 out there. What is my planned budget? My planned budget in this particular case is 16,000. So what is it? Let us look at revenue and spending. It is basically, if I look at, it is a variance which is unfavorable in this particular case. What is unfavorable in this case? That is, I should have got so much, whereas I have got What do you mean by unfavorable? I should have got so much, but I've got only so much in this particular case. So that is sort of unfavorable. I'm sorry. I should have got so much, whereas I have got only so much. That means it is unfavorable in this case. So unfavorable, I'm going to mark it in red out there, because let us get this guy U in marked in red, and then F marked in blue. Let me get this very clear so that I can mark all these things very, very clearly out there. Unfavorable. Let's look at the activity. If I look at the activity out there, because of the activity which is less than the budgeted activity, because the activity is less than the budgeted activity out there, I have earned, my flexible budget is less. So even this is unfavorable in this particular case out there, even this is unfavorable. My activity is also unfavorable. Now let us look at expenses. If you look at expenses, it says wages and salaries. What is it? 4,000 fixed plus 82 Q is what they have. What is the actual result? 8,430. What is the flexible budget? Flexible budget should have been 4,000 plus 82 into 48 out there. That should have been the amount out there. Again, what happens? You have spent more. You have spent more out there. That is, you have basically spent more than what you should have ideally spent. So there is an unfavorable variance out there. Unfavorable spending variance out here. There is an unfavorable spending variance. Let us look at further in this particular case. What is the plan? The plan was 8,100 out there. So what happens in this particular case? Your budgeted was 8,100, whereas you have spent only so much. So this becomes, what do you call it, as a favorable variance for you. This becomes what we call it as a favorable variance for you. That means you have spent less than what you have budgeted. Now I will go further in this particular case. After wages, that is fuel. Fuel is completely variable, that is 23Q is fuel. Actual fuel spent 1260. Budgeted, what you should have spent, that is 48 into 23 is what you would have spent. You have spent more. You have spent more. So unfavorable variance out there, it is unfavorable in this case. Instead of you, I will make it unfavorable. Unfavorable marked in red, favorable marked in blue. Let us look at the actual. Actual is 1150. So you have spent only 1104. So what happens in this particular case? It is basically favorable in this particular case out there. It becomes what you call it as favorable. Next, airport fee, which is again 650 plus what do you call it as 38Q out there. What is your actual? 2350, whereas let me look at 650 plus 38 into 48 out here. That's going to be, this is the number. That is my actual out there. So what happens? I have spent less than what is budgeted out there. So naturally there is a favorable variance for me. It is favorable for me. The revenue and spending is favorable variance for me. Because of the activity decline, what is the variance? That is what we are finding. Because of the, what do you call it as, we are comparing with the flexible budget that is estimated for that level of activity. That level of activity is what we do out here. So, in this case it is 2550. Of course, this is also going to be favorable for you. So, this is also going to be favorable. So, what happens in this particular case is this $76 is basically favorable for you out here. Next, aircraft depreciation. It is at 7Q. It is at 7Q out there. So, what is the actual? Actual is 336. Budgeted should be 7 into my 48 out there, 336. So, variance is blob 0. In this particular case, it will be 350 is actual budgeted. So, what happens? 14 is your variance out there, which is again favorable to a large extent. Next, I have office expenses, which is 190 plus 2Q. What is my actual? My actual is 460. What should have been my flexible budget? 190 plus 2 into 48, 286. Whereas it is really unfavorable, as you can see out here. It's $174, which is unfavorable. This is comparison with actual and flexible budget, the revenue variances. This is the activity level has decreased. Because of the activity level has decreased, what is the kind of variances? Activity variance, what we see out here. This is 290, and then this has a $4 variance in this case. Next, I have the last aspect out here, that is what we call it, I think we have finished everything. Next, we have total expenses. Total expenses, I am just going to sum this up out here, and I am just got my sum out here in this particular case. I am just going to copy it out here in these two cells out there. Let us look at overall, what is the kind of variance I have? Overall, I don't have a very positive variance out here. I have an unfavorable variance out here, whereas here I seem to have a favorable variance of about 304 because the activity has reduced. Because the activity has reduced out there, in this particular case, I have a favorable. What is my net operating income? My net operating income. Actual 814. My ideal situation, this should be this. Actual, if you look at, this is what is happening. And in this particular case, my actual is my plan, this is what I should have ideally earned out there. In this particular case, this 3560, this is again, please note, this is unfavorable because please note, unfavorable operating earnings. In this particular case, it's substantial, as you can see out there, unfavorable in this case. So, what happens? This gives you some kind of an idea about what you call it as the revenue and spending, actual and flexible when we compare. And this too we compare flexible and actual budget, that is the activity level. If you see which kind of, if you see the next question out here in this particular case, he says, which of the variances should be of concern to the management? Explain. I would say, overall you see that there is a $336 which is unfavorable activity variance. That variance is due to the fall in activity because you had initially planned for 550 flights, you have got about 48 flights out there. So, that is basically because of the unfavorable decreased level of activity. Whereas this 1710 variance out there, the revenue and spending variance out here, That is because of your inefficiency in collecting revenue. Please note, the second one, what 336 was because of the reduction in activity. This is relatively because of the company's, what do you call it as, net operating. That should be, that is, they are not able to. So, what is of more importance? More importance is this, not this. More important for the company is this variances out there. 494 of the unfavorable variance of the salary, yes. Fuel, yes. Office expenditure, total expenditure is of office expenditure. These are the variances which are of more concern than this. This is also of concern, I don't deny that, but this is of more concern out there. Okay, hopefully I've conveyed something. Now, let's look at one more numerical in this before we close. We will do one more numerical on this. As you can see, this problem number 6. Air Quality Test Corporation provides on-site air quality testing services. The company has provided the following cost formulas and actual results for the month of February. Fixed component per month, variable component per month, actual total for the month of February, and this is the thing. The company uses the number of jobs as its measure of activity. For example, mobile lab operating expenditure should be about 2900 plus 35 per job. That is 2900, as you can see, plus 35 fixed and variable, and so on and so forth out there. The company is expected to work about 50 jobs in February out here. That is the fixed part of it. That is what they expect, about 50 jobs to be performed. But the actual work is 52 jobs. They work more. Now, prepare a flexible budget out here for the month of February. Let us do one thing. Let us prepare what we call it as the flexible budget for the month of February, and these are the actual results out here. Let me take these into account and then let us prepare. That is problem number 6, if I am not wrong. With this, we will close the cost accounting part of it. That is, what is the problem? Air qual. Again, the same thing. I am just going to use the same, these two things out here, favorable, unfavorable. So, first we will talk about the actual, actual results out there. Then spending my variance. Then I will look at my flexible budget. Then I will look at my activity variance. And then my planned budget. Let us start one by one. I will write down all the aspects out here: revenue, technician, wages, mobile lab operating expenses, office expenses, advertising expenses, insurance, and miscellaneous. I will also enter the actual results of all of these, that is 18,950, 6,450, 4,530, 3,050, 995. Oh, sorry. I will also enter the all these expenses right away. For actuals, 18,950, 6,450. Mobile lab is 4,530. I have not looked at the fixed and actual because I am entering only the actuals out there. And office expenditure is 3,050. Insurance, advertising is 995. Insurance is 1,680. And then 465 is miscellaneous expenditure. I have done this. Let us prepare the planned budget as of now. Planned budget as of now. What do they say? I am going to add one more as item out here. That is, what are we looking at? That is the in this particular case, what is the number of jobs that is done out here? The number of jobs that is done is about 50 and 52 out here. So we will say number of jobs actual is 52, flexible is also 52, whereas planned is only 50 out there. So the number of jobs in this particular case, I am going to use a different color for this. The number of jobs out there is going to be, this is the number of jobs. But we need this for calculating the flexible budget and the fixed budget also. Let us look at the planned budget. What should be the revenue? Revenue, it says revenue is $360 is the revenue into the number of jobs out here. This should be the revenue out here. And what is the technical wages out there? $6,400 is basically fixed in this particular case straight away. Mobile lab operating expenditure is about $2,900 plus what do you call it as $35 is fixed into the number of jobs out there. And my office expenditure is $2,600 plus $2 into number of jobs out here. Advertising expenditure is $970 fixed out there, now variable. My insurance is $1,680 fixed out there, no variable. And then my miscellaneous expenditure is $500 plus $3 into my, what do you call it as the planned budget out here, and that's what it is. Now let us look at the flexible budget part of it out here. Flexible budget is going to be 360 into this is the number of revenue that I should have earned. Now let us look at all these activity in this thing. I have earned more revenue than I should have earned. So what happens? Favorable in this particular case. My revenue is favorable. My revenue is favorable out there. My activity is 52 in this particular case out here. If you can see this, my activity in this case is 52. So what happens? I have estimated to earn more than what it is. So basically my what do you call it as my activity is also sort of favorable to me because I have earned more in this activity. Now coming to the expenses, let us look at the expenses out there. Expenses, budgeted expenses is budgeted expenses in this case is 6,400. I have spent 50 more, you can see that. So unfavorable, the $50 what I have spent is basically unfavorable in this case. It is blob out here, not because it's fixed. Mobile lab expenditure 2,900 plus 35 into 52. 4720 I could have spent for 52 units, whereas I have spent only 43, 40, 45, 30. So what happens? It is basically favorable for me, favorable in this particular case, it is favorable variance for me. In terms of spending, I have spent less. In terms of activity, it is unfavorable because what happens? I should have basically, what do you call it as, I should have restricted to this, but I spend more. So what, sir, if it is unfavorable, it should be favorable because you have done more activity. Agreed. But please note, you have budgeted for this expenditure, suddenly your expenditure goes to this. You have budgeted for 4650 expenses, now suddenly your expenses go to 4720. You have to source money for that. When you have to find money, then there is somewhere rearranging, rejigging you will have to do on that. You are earning more, agreed, earning more, fine, but is it earning more, is it sufficient? Let us see that. In this case, that is what it is. So that is where we say it is unfavorable. My office expenditure, what should it be? My office expenditure is 2,600 plus 2 into what do you call it as my activity out here. This should have been my activity, but it is unfavorable. I have spent more. Basically, it is unfavorable as of now. In this particular case, my spending is unfavorable. my advertising should be my advertising should be 970 out there, whereas I spent 995. In this case, again $25, which is again, what do you call it, as unfavorable in this case. My insurance, I spent the same 16, I basically spent the same 1680. So what happens? My zero variance. Miscellaneous, I could have spent, what happens? 500 plus 3 into what is called as, this is the number of activity. I could have spent this, but it is highly favorable for me in this particular case out here, highly favorable. I am looking at this part of it in terms of my spending. Same thing, I'm going to look at out here. This is going to be what you call it as unfavorable out here, and I'm just going to look at unfavorable out here in this particular case. Going to be blob, and going to be again unfavorable in this case. Why unfavorable is important out here also? Because you need to source that kind of money out there. Now imagine, you need to source that kind of money out there. Now what is the total expenses? My total expenses is, I'm just going to sum all these things out here, and this total expenses is, I basically summed out here, and I am got it out here in this case. My total expenses itself is basically favorable in terms of spending out there. Is unfavorable in terms of spending out there. My total expenditure, if you look at, is unfavorable in terms of spending out there. My total expenditure is unfavorable, though some of the things are favorable. My total expenditure is unfavorable out here, and even here it obviously is going to be unfavorable out here, because that means so much of expenditures extra, that means you have to source so much of money out here. Net operating income is going to be, what do you call it, as revenue minus my expenditure, and I'm going to copy the same thing in out here in this particular case and out here in this case. In terms of activity, yes, more activity, it has resulted in more profit. That is certainly favorable for you. Agreed, it has resulted in a $640. It should have resulted in $640 more. Agreed. Whereas how much has it resulted in terms of activity? Yes, it has resulted in about basically only $190 more in this particular case. You see that it should have, because of the increased activity, you should have got $640 more profit, whereas you have got only about $190 more profit in this particular case out there, because of the increased activity out here. So there are some favorables, some unfavorables. What do you focus on? I focus on this, I focus on this, I focus on this, I also focus on this, because just because I've earned more is favorable, I cannot keep quiet. If I earn more, am I really is my budgeting wrong? Am I really budgeting at a lower cost, lower revenue? I'll have to go back and relook at it. This is what we call it as simple spending variances, activity variance. Thank you very much. With this, we end the cost accounting part of it. Now, next class onwards, we are moving towards the finance part of it, pure finance part of it, the two parts of finance, the sourcing as well as investing part of finance. Thank you.